everybody, James Akers here. Today's topic that we're going to be discussing is how much should I put into my 401k? Now you can substitute 401k with IRA or TSP or whatever type of program that you have, but specifically what I'm going to be referring to today are work employment programs like a TSP or a 401k. So the question I get asked a lot is how much should I contribute to my employer's retirement plan? The answer I'm going to give you right now, very, very simple, short answer, and then I'm going to describe why. The answer is you should be contributing as much as your employer is to your 401k. That's the short, simple answer. You should contribute as much as your employer does. That's, again, the short, simple answer. Now, I'm going to go into some more detail in just a minute. Let me explain to you what I mean by that. Let's say you work for employer ABC company, and part of your benefit package is they will match 3% of your annual income in contributions to your 401k. Then I would suggest you do 3% of your income. So to make our math easy, let's say you make $100,000 a year. So if you're making $100,000 and you contribute 3% of your pre-tax income, because it's a qualified plan, that's approximately $3,000 that you're contributing to the plan. Your employer is then going to match that and also give $3,000. So you have $6,000 a year being invested into your retirement plan. That money then is going to be managed by an outside agency that manages 401k plans, and they're going to do their best to get a good return on that. Now, because the stock market is volatile, we don't know what's going to happen. Obviously, 401ks go down, they go up, they go down, they go up. I just heard a story of someone that's lost almost $100,000 in the last year and a half in their employer retirement plan. Back in 2008, 2009, people lost half of their retirement savings because of what happened with the stock market. So that's why I say contribute what your employer is willing to match. I wouldn't go one penny over. Okay, let me go into some detail now. Let's say in that same scenario, you're making $100,000 a year, and you say, well, I could afford to put $10,000 a year into my retirement because I want to retire wealthy. I want to be in good shape when I retire. First of all, good job. Kudos to you. I'm in the same boat. I want to retire wealthier than I worked. So that's why I focus a lot on my personal retirement. But if you would take that extra $7,000 and put it into your 401k, again, we're using the same scenario. Let me make sure I itemize this out. So you're making $100,000 a year. Your company is matching 3% of that, so you're putting 3% or $3,000 into your 401k, and you decide you want to put another $7,000 into it. So now you're putting $10,000 into your 401k. Your employer is only matching the 3%, so your employer is giving 3%. So now you have $13,000 a year going to your 401k. Well, that's awesome if the market doesn't go down. That's awesome if you trust the people that are managing your 401k. Here's why our advice at Akers Financial is give what your employer matches. Take the other 7% or $7,000, work with a financial planner to create your own individual retirement plan. Don't have all your eggs in one basket is my advice. So if all your money's in that 401k and we have another stock crash like 2008 or like what happened during COVID, you could lose a chunk of that extra 7% that you're putting there. Whereas I would advise you to have that money in some sort of a program that has some guarantees built into it. And the other thing I'm going to suggest is that you don't use a qualified plan for that extra 7%. Now, I'm getting a little bit detailed here, so let me break it down to simplicity because I'm sure we have some very smart people that know this stuff that watch this video, probably some people that just don't understand how it works because I talk to both types of people, and that's cool. I want to try to explain that to you. So the difference between a qualified and a non-qualified plan, a qualified plan comes out of your paycheck before you ever get paid, before taxes are taken out, before anyone touches that money. So if you're making $100,000 gross and you have 3% going to your 401k, then $3,000 goes into your 401k. It's not taxed. It goes into what we call a qualified plan, which means the IRS has never touched that money. The purpose of that is you pay taxes when you retire. So what you're doing is you're just delaying paying taxes. Trust me, you got to pay taxes. The IRS ain't going to let you buy without paying taxes because they take it from you every which way they possibly can, right? So you're just delaying paying taxes. Well, what if tax rates go up? over the next, let's say you're 45 and you're going to retire at 65. What if taxes go up drastically in the next 20 years? Then if you're delaying paying taxes, you're going to pay a lot more on income tax if the taxes go up. So my recommendation is this. Match or max out whatever your employer is willing to contribute to match on your 401k. Max that out. Take every other penny that you can possibly put into your personal retirement and do a non-qualified, meaning let the taxes be taken out of your check, and with what money gets paid to you or direct deposit to you, then finance a second retirement with that money. That means it's a non-qualified plan, which means you've already paid taxes on it. What you're doing is you're paying taxes now because taxes are pretty low. We've had a lot of tax breaks over the last few years. So you're going to pay taxes now while taxes are on sale, as I like to say when I talk to my clients. And you're not going to pay as much on income tax. You will on some of the gains, but you won't pay as much on income tax when you actually retire through the non-qualified. This way you've got two baskets with your eggs in it. You've got your employer matching the one basket, which is great. But then you have a second basket that you work with a financial planner that makes sure that that money is going to grow, that you don't have any losses. Maybe a fixed indexed annuity or some other, maybe a tax-free retirement plan. There's a lot of things you could do with that money that is non-qualified but has guarantees built into it. Then if the 401k crashes, you still got the second retirement plan. Do yourself a favor, take care of you. Lastly, I want to just touch on real quick something about the employer plans. I want to make sure everyone understands this. Make sure before you retire you are what we call vested. Okay? So if you're considering a career change, let's say you've worked at the same place for 5 years and you've put money into your 401k, but you want a career change. So make sure that you have worked enough years to be able to take the employer's contributions with you. Here's what I mean by that. If you're putting $3,000 a year into your 401k and you work there for 5 years, you've got $15,000 that you've personally contributed, and your company has contributed the same $15,000. But let's say your company has a vesting program that's, I don't know, say 6 years. Now, most companies are not that long. I'm giving you a drastic example to make sure you look into it. So if the vesting is 6 years, then what happens is if you leave that company prior to the 6 years, you don't get the employer's contributions. You only have your contributions because you weren't vested. V-E-S-T-E-D, vested. Make sure you're vested prior to leaving your employment. That could make a major impact on your decision to leave a company if you've worked there for a while, is if your 401k plan is vested. So that's just some advice I'm throwing in for free on this topic. Okay, so to summarize everything, max out whatever your employer is willing to contribute to your 401k, your TSP, or whatever retirement plan you have. Find out from your HR department, do they do 5%, do they do 3%, whatever they're willing to match, max that out is my advice with your pre-tax money into a qualified plan. If you have more budget to fund retirement, then work with a financial planner and get a secondary private plan that's not through your employer, so your eggs are in two baskets. And that way you have two different growth tools. And when you go to retire, you have two different revenue streams, plus your Social Security. So it's 3 different revenue streams. Trust me, you'll thank me later for this. Guys, I hope this helped a little bit. Max out your 401k, only what your employer is willing to contribute. Put the rest somewhere else. I hope you guys have a great day, and God bless you.